Yes, you can expense 100% of qualifying new equipment this year. And I'll show you how to keep that cash in your business instead of watching it disappear. Hi, I'm Erica Jones, certified fractional CFO, certified Profit First professional, and certified Relay Bank cash flow advisor. This is my part 3 of the One Big Beautiful Bill series, your weekly playbook to turn your policy into profit. Now, today's play, number 1. We're going to go over how the revived 100% bonus write-off works on new assets. Number 2, when to use Section 179 for used assets and software. And number 3, the profit first move that locks the savings into your account so it actually shows up as cash. All right, number 1. The 100% write-off is back. Let's say that again. The 100% bonus depreciation. In plain English, if you buy new qualifying equipment, technology, or certain vehicles and place them in service this year, you can expense the entire cost right away. So why does this matter? It's not just a tax win. It's a cash timing win. Instead of spreading the deduction over 5 or 7 years, you're front loading it into this year, which reduces your current tax bill and keeps more cash in the business now. So let's go over some examples. Let's say you got a new delivery truck that costs $100,000. With 100% bonus deduction, you're able to deduct $100,000 this year. A new kitchen line or production equipment, you can deduct the full amount the year is placed in service. How about cloud-connected POS and back office tech? Does that qualify? Same idea. Expense it now if eligible. Think about the phrase place in service. It matters. Delivery and installation dates determine the year of the write-off. This is for new property in this context. Okay, we're going to cover used property next with Section 179. But hear me on this. Please. You don't buy for the deduction. You buy because the asset increases throughput. It reduces labor hours, improves quality, or lowers the downtime. The deduction is the accelerant, not the reason. So as a CFO, I want you to ask yourself this question before you sign. Will this asset meaningfully improve capacity or efficiency in the next 90 to 180 days? If the answer is weak, pause on the play. So now let's go over Section 179 for used assets and software. Okay? Section 179, this is your power move for used equipment. Certain vehicles and off-the-shelf software. How do you think about it? Use Section 179 when you're acquiring used assets or qualifying software, and you want to expense up the annual cap. Now, it is subject to business use tests and vehicle limits. So you will use the 100% bonus depreciation when you're acquiring new assets that qualify and you want the immediate deduction. Okay. So in some cases, you can combine the strategies, but the right sequence depends on your facts. So run this model with your tax pro, your CPA, your CFO, your financial advisor. Okay. Remember, business use percentage must be legitimate and documented, especially for vehicles. Passenger vehicles have special limits. Heavy SUVs and certain trucks may be treated differently. State rules can differ from federal. Don't assume that there's uniform treatment across all states. New assets, they have a strong return on investment. Placed in service this year. The model 100% bonus depreciation. This is for used asset or off-the-shelf software. There's a strong return on investment based on the model. Section 179. If you're within the 12 months of a sale or exit, include the recapture and basic planning in the model. Now, my favorite part. How to protect the savings with profit first. Here's what I see all the time. Owners capture the deduction. They feel richer. And then the tax savings quietly melt into the lifestyle creep or random spending. This results in no durable improvement in their cash. So how do you fix this? We use profit first to assign the savings the same week the purchase closes. So my default split for tax-driven windfalls, 40% goes straight into the profit account. That's the owner's distribution or retained profit. 40% goes to the owner's pay. That's for stability. You reward yourself. Pat yourself on the shoulder. 20% go into debt reduction or cash reserve. Now, you can tweak those percentages, but the principle is non-negotiable. Name the dollars and move the dollars. When you assign the savings, guess what? You keep the savings. Let's say you have a multi-unit franchise, right, that invests $180,000 in new line equipment mid-year. With 100% expensing, taxable income drops by $180,000. At a 30% blend tax rate, that's roughly $54,000 of taxes avoided this year. So what we do? You move $21,600, that's 40% to the profit account. You move $21,600, that's another 40% to the owner's pay. And you move $10,800, which is 20% to the debt or reserves. So now a tax strategy becomes a cash control strategy. The balance sheet gets stronger and the owner actually feels the win. Got any questions? I got some that you might want to know the answers to. Do I need to be profitable to benefit? You need a plan either way. If the profit is thin, we can still use timing strategies, but we won't buy anything that doesn't move the P&L. Some of you might ask, lease or buy. You have to model the total cost of capital and match payments to the cash the asset creates. Cheap monthly payments on a weak asset are still a bad deal. Some of you might want to know, can I expense improvements? Sometimes. Repairs and maintenance versus improvements are treated differently. Coded correctly in your fixed asset policy. Some of you might want to know, what about vehicles? There are caps and special limits. Keep the mileage and business use documentation tight. Heavy vehicles can be different from passenger autos. Model it. Okay? Model it with your professional. This week, I want you to do a few things. I want you to list any planned purchases for the next 6 to 12 months. Next, for each answer, I want you to answer for each one. What profit driver does this improve within 90 to 180 days? Then I want you to tag each item as new or used and run the bonus versus the 179 eligibility with your tax pro or your CPA or your CFO. So when you greenlight a purchase, set your automatic transfers to move the tax savings into profit, owner's pay, and debt or reserve immediately. I want you to take the money story assessment at sheknowsprofits.com. Take the My Money Story assessment and let's get your profit clarity call booked today. I'll map out your next 3 cash moves so you keep more of what you earn. Meet me next week. The employer tax credits most owners skip. Think childcare, paid family leave, a few easy wins hiding in plain sight. I'm Erica Jones. Remember, profit isn't what you earn. It's what you keep. Let's keep more.